Hello investors, welcome to Simpli Stocks. I am continuously in search of good microcap or penny companies which have the potential to grow their sales rapidly. My approach is that I allocate half to 1% money of my portfolio into multiple microcap businesses. Then whichever company keeps delivering good results, I keep building my position in that, and the ones that deliver poor results, I take them out from my portfolio. So today I will discuss with you 4 interesting microcap businesses which I have recently added to my watch list. I am tracking them closely. We will understand their business models, and we will also try to understand what special is happening over there. But remember, none of these companies in any way are buy or sell recommendations. You should keep that in mind. And since these are very small companies, the volatility and risk in them is also higher. You have to keep that in mind as well. With this, let's begin. The first microcap business we will study is Tembo Global Industries. Traditionally, Tembo Global has been in the low margin textiles business, but now they are entering into engineering products, defense, and solar sectors. You will see that in Q1, meaning in the months of April to June, 61% of their sales came from textiles, and the remaining 39% share was of the engineering products division. In their textiles business, they process fabrics, fibers, and yarns and then supply them further to brands, retailers, chain stores, etc. Talking about engineering products, in this business, they make heavy duty clamps which are used in shipbuilding, industrial machinery, large vehicles, and refineries, etc. They have 15,000 metric tons manufacturing capacity for these engineering products. Apart from these, as you can see here below, they are entering in two new product segments: ERW pipes with 60,000 metric tons capacity and strut channels with 30,000 metric tons capacity. ERW pipes are used in oil and gas and water and sewage management. Strut channels are used in construction, electrical, and plumbing works. This capacity will start in Q2, that is in these months of July to September. With this, their total manufacturing capacity will become 7 times, from 15,000 metric tons straight to 1,05,000 metric tons. Apart from textiles and engineering products, Tembo Global also provides EPC services, like they do construction work of fuel farms and marine jetties. You can think of a fuel farm as an oil pump for ships and airplanes. Ships and boats dock at marine jetties, so that is their use. So Tembo also takes such EPC projects. This too comes under their engineering solutions segment. Now, if I summarize through this screenshot, right now Tembo Global is in these two businesses, engineering solutions and textiles. And going forward, they will be entering solar power generation and defense manufacturing. Currently, roughly 60% of their sales come from textiles and the remaining 40% from engineering. But their estimate is that in next year, that is FY27, 60% of their sales will come from the engineering division, 10% from textiles, and the remaining 20% share will be of defense and 10% of solar power. And here you will notice that their textile segment has only 2.1% EBIT margin, whereas engineering solutions has 17.6% margin. So as this transition will happen from low margin to high margin business, we will also see good expansion in the bottom line or net profit. Let's look at their recent results now. In Q1, their sales grew by 93% or almost doubled compared to last year, reaching almost 250 crore rupees. In the bottom line, there has been a tremendous 253% growth. Their profit increased from 5.4 CR last year to 19 CR this year. Along with this, you can also see margin expansion happening over here. EBITDA margin went up from 6.5% to 11.4%, and PAT is up from 4.2% to 7.7%. Tembo Global's management has given a target of 1100 crore rupees in sales for this year, which translates to 48 to 50% sales growth over the last year. Now, if we assume 7.7% profit margin, which they had in Q1, then this year they can reach a bottom line of around 85 CR. So on this year's estimated profit, Tembo's 1 year forward PE comes down to just 10. And then their ERW pipes and strut channels capacity is also going live. So this looks like a very interesting undervalued business to me, which you can study on your own. Now, the next business we will study is Krishival Foods. Krishival is an FMCG company, and they are in the business of selling packaged dry fruits. Apart from this, last year in September, they acquired a 53% majority stake in an ice cream company named Melt and Mellow. So now they have these two business segments, packaged dry fruits and ice cream. Their Q1 results have been quite good. You will see in this screenshot from the press release that their sales have grown 70% compared to last year, and net profit has grown by 30%. This quarter, Krishival earned a profit of 4.4 crore. Talking about their geographical presence and reach, their dry fruits business is more focused in Tier 2 and Tier 3 cities. Apart from this, the Melt and Mellow ice cream brand has presence in Maharashtra, Karnataka, Goa, and Telangana. And recently, they have also opened dry fruit stores in Goa and near Mumbai. They also sell their products through Amazon, Flipkart, Blinkit, Zepto, etc. And they are also targeting the Singapore market for exports. Krishival caters to a slightly premium market in dry fruits, and in the ice cream business, they are expanding into underpenetrated markets, meaning such regions or localities where other brands are not present or their presence is not that strong. So broadly speaking, Krishival is currently playing a distribution game. Right now in India, the packaged dry fruit market or the D2C segment is seeing good growth. Like you yourself may have eaten dry fruits of brands like Farmlay, Nataraj, or Happilo. In dry fruits, you would have noticed that mostly dry fruits are sold loose, and there are many grades, different varieties available. So when they are sold loose, and dry fruits are obviously expensive too, so there are trust issues at the customer's end. And because of so many varieties, there is also confusion. So people have trust on brands. That's why this packaged segment is doing very well. All companies on one hand are working on sourcing good quality dry fruits, and on the other hand are expanding their distribution so that more sales come. Similarly, in the dairy segment, the value added product segment in which your ice cream and other products come, that segment is also seeing good growth. This market is growing at around 13.5% CAGR. Now talking about valuation, Krishival's market cap is around 900 crore rupees. In this June quarter, their profit was 4.4 crore. So if we take the full year run rate, that Krishival will at least earn this much every quarter, then their estimated profit for this year is 4.4 into 4, roughly 18 crore rupees. Screener will currently show you a PE of 67, but its 1 year forward PE comes out to 50. For a microcap business, yes, I agree, this is a premium valuation, but you can keep this business on your radar for correction opportunities. Apart from this, if in upcoming quarters the net profit is higher than 4.4 crore, then that too can be a good trigger in this business. I liked Krishival because their base is small. If their management is able to expand distribution and execute well, then in the 2 to 3 year period, this premium valuation will not matter that much. Now, if you are interested in this, the risks that you have to see are the company does not hold conference calls with investors. So there is not much information about the direction the business is heading in. And since it is a distribution-led business, a sudden slowdown is another risk you will have to be watchful about. Now, so far, if you are liking this video, do give me a thumbs up. Also, you can subscribe to our channel Simpli Stocks, where we bring multiple such videos every week. Honestly, your likes and subscribes are our only motivation so that we keep bringing such high quality research to you for free. So do like this video and subscribe to our channel as well. Let's come back to our businesses. The third business we will study is Faze 3. Faze 3 is a textile company, and it is in the business of manufacturing and exporting rugs, curtains, fabrics for kitchen use, blankets, and throws in the low to medium price range. Almost 55% of their sales come from USA. So Trump's 50% tariffs on India are a risk for them. But if you are able to read here, they have written in very small font. I have taken this screenshot from their investor presentation. So most of Faze 3 products in the USA are sold in the range of $8 to $25 per piece, approximately 650 to 2000 rupees range. For Americans, this is not a big amount. And their clients sell these products to end customers at 3 to 4 times the rate at which they purchase from Faze 3. So even on a 20% tariff, the retail price will only increase by 5 to 7%. And on 50% tariffs, the rate will increase by 15%. So management believes that tariffs will not have a very major impact on their business. Even with tariffs, their management estimates that in the next 2 years, they will be able to grow their sales at rate of 22 to 25%. For the past 2 to 3 years, they have been increasing their manufacturing capacity. Even now, they have an ongoing capex at their Panipat plant for cotton textiles division. and broadly across different product segments, they are running at 45 to 50% capacity utilization, meaning that from here, that is this point, the company can increase its sales without making any further investment. This quarter numbers have been good. You will see that sales grew by 42% compared to last year, and in net profit, we saw a very strong 76% growth. Net profit margin increased from 4.8% to 5.9%. Profit growth has been higher than sales growth, so we can say they also got operating leverage, and management says that going forward too, they will continue to benefit from such operating leverage, and they have a target to double their sales in the next 4 years by growing at 22 to 25% CAGR every year. But if you go and check, due to tariff uncertainty, Phase 3 has corrected 30% in the last 1 month. The business is currently trading at a PE of 25. My view here is that fundamentally strong businesses which are debt free or have low debt and which have a good cash balance on their balance sheet, those businesses will be able to overcome this tariff related uncertainty and can do well in the long term. And one thing I like in Phase 3 is, if you see their shareholding pattern, their promoters have been continuously increasing their stake in the business. They are quite confident about their business. And if you see below, you will also notice that the name of Ashish Kacholia is there. He has 5.4% holding in this. So Phase 3 is also a good microcap business which you can keep on your watch list. Fundamentals are good, there is good growth, and due to uncertainty, the valuation is also looking attractive here. Now, the fourth and final business we will study is Unihealth Hospitals. Unihealth operates two hospitals in Africa, one in Uganda with 120 beds and one in Nigeria with 80 beds capacity. Apart from this, a small portion of their sales also comes from distribution of medicines and medical consumables like syringes, gloves, etc. Last year, Uganda contributed 75% to their total revenues. India contributed 16% and Nigeria just 7.7%. Nigeria's contribution used to be higher, but the currency devaluation has happened over there. Nothing much is expected in the future either, and they are slowly taking exit from that market. So we can say that Unihealth's main business is currently being run only from the Uganda hospital, which has 120 beds capacity. And this is also a kind of plus point here. I'll tell you why. So that their base is very small right now, and they are expanding rapidly on this small base. Like this year itself, they will be opening 3 new hospitals with a total bed capacity of 350 beds. In this, a hospital with 60 beds capacity will come in Mumbai, one with 190 beds in Nasik, and another hospital with 100 beds they will be bringing in Tanzania, East Africa. Meaning that within 1 year, their capacity will go up to 4 times, from 120 beds to 470 beds. Then Unihealth has a target to double this 470 beds capacity to 1000 beds in the next 3 years. If the management is able to execute well on these plans, then on such a small base, Unihealth can bring back to back very strong business growth. If we calculate their growth, then for the next 3 to 4 years, it translates to a tremendous volume growth of 75 to 100% CAGR. I found their conference call quite interesting. Their management is very clear and focused about their strategy. You will see that big and famous hospital chains like Apollo and Sahyadri operate hospitals with capacity of more than 200 beds. Their hospitals are large in size. Their people trust the name of the brand more than the doctor's name. But Unihealth's target is to open smaller hospitals in the range of 50 to 175 beds, where they will provide treatment and care to patients with a more personalized touch. You won't get this in a big hospital chain. So this is going to be one of their USPs. So Unihealth looks to me like a high growth model on a small base. You can study it yourself. It is currently trading at a PE of just 16, 17. Risks you have to keep in mind here are, firstly, this is an SME, so its results are declared only twice a year, in March and September. Apart from that, the company is very small in size. As you can see here, the market cap is just 250 crore rupees. So if things go wrong or if results turn out bad, then liquidity will be a problem here. Now, if you like this video, then do give me a thumbs up. A lot of effort and time went into making this video. If you support us, we will be able to bring you many more such high quality research videos every week. Along with this, you can also subscribe to our channel Simpli Stocks. I will see you in the next video. Happy investing.